Hi everyone, my name's Lan Nguyen and welcome back to the Success Wealth Show. So for this episode, my guest today is Grant Abbott, who will be joining us and talking about how we can protect entrepreneurs' wealth. We focus on helping you build and create businesses and wealth, but we also need to have the plan and strategies how to protect it as well. So Grant, welcome to our show.
Oh, thanks, Lan. Thanks for having me on. And I'm up here, the beautiful Sunshine Coast, and I can understand. I heard it's hot down there in Melbourne, so it's great to be joining you.
Yes, it is. So, Grant, for those of our viewers who don't know much about what you do so far, can you please give an introduction of what are some of the projects that you're currently active on?
Yeah. So, look, my background, I started. I did a Bachelor of Economics, and I did a Bachelor of Laws, then a Master's Law specialising in taxation and international tax, and then worked at KPMG, Rothchild in the funds management division, specialising in super. And the last 20 or so years, I've had my own business where I've specialised a lot in self-managed superannuation funds and also asset protection and estate planning. I've written 5 books on self-managed super funds. The latest one was The Guru's Guide to SMSFs, which you can get at Booktopia or wherever, which is a great book. And currently writing a book on succession, asset protection and estate planning. So that'll be a project for me over the holidays with a couple of other professionals. But at this present point in time, a lot of the projects we're working on is building specific product to enable small business owners to effectively protect their family wealth. And I know a lot of them have already set up through their accountants discretionary trusts or self-managed super funds, which by themselves are good asset protection mechanism generally, but unfortunately a lot of them have not been set up properly. So we just have to be very careful. Coming from the legal field, I know how to attack these things. So essentially you want to be in a position of creating a moat around your family's affairs, so that if the regulator gets you, or if you're being sued, or even on death, to make sure that your assets are going to the right place. Which then brings into the other side is effectively, do you want your wealth to be transferred to your bloodline, or do you not care? For example, I find when I do presentations, I've done over 2,000 presentations in my life, and whenever I ask that question, do you want to make sure that your family wealth goes to your bloodline, rather than seep out to one of your children's stepchildren, so on and so forth, the answer comes back affirmatively, 95%, absolutely. So we've got a couple of things there. Not only do we need to protect our assets during our life, but we also want to make sure that on our death, that effectively our assets are passed over to our bloodline only, if that's your desire. If that's not your desire, if you don't care about protecting your family assets or where your assets go on your death, then certainly this talk is not for you. Go ahead.
Sorry, Grant. I'm just looking at the image about the castle in the middle, and the water is the moat that you say. That's a very, I guess, simple way of putting it. What estate planning is, isn't it?
So it's also asset protection. So you might have one of those turrets, might be your business. Another one might be a family home. You might have an investment property or two. You might have your SMSF. And look, if you don't have that moat around it, effectively, you might open, and I see so many people just have no asset protection. And quite often they've been advised by lawyers who really don't know what they don't know. And so they've got, the gates are open, the hordes of other lawyers are in there scaling around doing whatever they want. And then essentially what our goal is to ensure, particularly at Abbott Morley, I know also with yourself, Lan, is to build that moat around, fill it with, crocodiles, germs, everything, so that, it just makes it very unpalatable for a lawyer, particularly a no-win, no-fee lawyer, to actually attack that moat or attack the castle. And so that's essentially what we're doing. Nothing's guaranteed, but certainly at least the best thing to do is get 99% there. And effectively, as I said, no win, no fee. Lawyers generally give up if they can see that it's going to take a long time in court.
That's right. So let's talk about this moat and break it down. What can you tell me about the moat structure, like for our viewers to understand better?
Look, I'm sure a lot of your clients and most clients around Australia, asset protection, generally a lawyer or an accountant will set up a discretionary trust. They've got a corporate trustee. For those of you lucky enough or smart enough to have a self-managed super fund, which is an awesome tax vehicle to put in place for small business owners. In fact, it's almost mandatory if you ask me. Again, you might just have a plain stock standard SMSF and a trustee company. If you're doing really well as a small business owner, traditionally you will obviously stream out income to all your adult children, your spouse, etc. But where you go over the 30% tax bracket, you'll just put it into a bucket company, and then generally you'll still utilise the money, but then there'll be what we call a loan back to that company that you'll obviously accrue interest on. And you'll see on the left-hand side we've got a family protection trust. Not many people utilise that, so the picture you got on a screen is the updated version, which is ideally where you want to go. You want to have a leading member discretionary trust, and I'll talk about that a little bit later on. It's the royal version of the discretionary trust. In fact, it truly is the royal version. Likewise, the SMSF, leading member, and also family protection trust, and all of those have got their own special purpose companies. Now, if you've already got some of these vehicles in play, then it's just simply of upgrading to the next level, and essentially that gives a greater asset protection, but also more importantly ensures that your benefits are there mainly for your bloodline, distributions for your bloodline. The same thing on death. For example, a death benefit paid out of an SMSF will only ever go to your bloodline. So we can do all of those sort of structures, which we're going to cover over the next few minutes.
So when as a business accountant, a lot of business owners cover off on asset protection for their business, but they don't really consider estate planning issues. So, Grant, can you share some of those issues that our entrepreneurs need to be aware of, and the solutions when it comes to asset planning for their business and their family wealth?
So one of the issues is, I suppose, if we just look at the asset protection, I'm sure most of your small business owners, really understand that, they can effectively be, if they're attacked through litigation. And look, don't worry about litigation. The worst ones are actually the regulators. The regulators can garnish your bank accounts. So if you've got fines or ASIC decides to attack you, put you out of business, effectively you're pretty well stuffed. And any penalties you can't sort of waive, they can garnish your business. So unfortunately, the discretionary trust that we do establish for our clients, the danger you've got there is that if there's an attack on that discretionary trust, then effectively it can be locked and loaded, and you can have a dissipation of your wealth. And that's something you've got to be very careful about. The other side of the coin is, when you have a look at those assets, as I said, what happens if you're successful over time? A lot of your wealth is going to be built up into your bucket company. And the problem about that bucket company and any other assets you own, traditionally we've got our principal place of residence, which we need in order to gear up or make a borrowing for our business purposes, making a loan into the family trust or discretionary trust. Likewise, it makes sense to, if we want to get some tax relief, because we're doing well, we may end up negatively gearing property outside. So obviously we can get those tax deductions, which is complete waste inside the discretionary trust. The problem is the tax system is devised for us to hold assets in our own name. That's where all the juicy incentives are. But that also means they're all open to any challenge of asset protection. And the same thing on death. If those assets are sitting in your estate, you may not be aware, but any person, any eligible person can make a claim on your estate. So it doesn't matter how brilliantly I might do a will or with testamentary trusts or the best lawyer in the world, effectively you can't protect against a family provisions claim. In fact, there was one just recently where a friend, usually the family provisions claims are generally with children or spouses, ex-spouses. In fact, I've seen ones with ex-spouses from 27 years ago making claims. One recently that went through the courts was from a friend who made a claim. And the problem about that is once you've got those, it now means your whole estate is exposed. And it's not only exposed from, you might say, I want this to go to this child, this to go to this spouse. Effectively, if it's challenged, you're looking at a Supreme Court action. Of course, the no-win, no-fee lawyers love doing that. Just go into Google, do no-win, no-fee lawyers, and you'll see they're all over the internet. And what they'll do is they tie up that estate for 3, 4, 5 years in litigation. There was a really good case over in Western Australia. It's called the Taylor and Miller case, which was settled in 2018. It was from one asset being Andre Taylor's house, had no mortgage on it, was worth $600,000. He died in 2013. By the time they finished, they got to the final hearing in the Supreme Court of West Australia in 2018. What had happened in that case is his 2 children, he left everything to his 2 children, but he had a de facto spouse for 10 years, and obviously she made a family provisions claim, and rightly so. He should have really taken into account what was to happen to her, certainly the executors. But by the time, the lawyers get them all pumped up, 5 years down the track, at the final hearing, in fact, Justice Jeremy Courtois from the Western Australian Supreme Court really ripped into the lawyers because the $600,000 estate had over $500,000 in legal fees. So it didn't matter the fact that he awarded a third of the estate to the de facto spouse and a third to each of the other children meant nothing because there was nothing left because it had all been taken in legal fees, which is the game that they play, which is why we want to use, and you saw the picture before, ideally to have that family protection trust so that our net worth, not necessarily our assets, because we still want those juicy tax assets outside, but our net worth is actually residing in an estate. And that's through a vehicle called the protector.
Okay. Before you reveal the protector, I wanted to just note that I think 9 or 10 out of 10 people have their home in their own name. Okay. So, absolutely. And then you also mentioned a very valid point that people do have the investments, especially the first investment property in their own name for negative gearing.
Yeah, absolutely.
So if you're one of those people and you're running a business as well, you need to listen to the next part, which is the solution or what you can do. So what can they do, Grant, if they have that?
Absolutely. Absolutely. So, exactly what you were talking about, Lan, and I know that, you're very au fait with that, is, as I said, look, I've got a master's in law and taxation. So the first thing that every accountant, good accountant, I know, Lan, you do this with your clients, is you put your family home in your own name, or it might be jointly with yourself and your spouse. And then obviously get those 1 or 2 investment properties, because those negative gearing deductions can be used to minimise any tax from distributions that you're receiving. So look, it makes huge amounts of sense. I mean, the fact you've even got a trust, when you're using that for income streaming and to minimise taxation across the family group. But again, those assets that are in your own name are laid bare if you're attacked. If the regulator wants to go if there's any instances, during your life, you've got that problem. And as I said before, from my perspective in estate planning, again, if you're left with those assets on your death, it just makes sense for any lawyer. It doesn't to dig out someone, whether it's a friend you've looked after in the past, any aggrieved child, to really make a family provisions claim. Because if you've got $1 million estate, I can tell you once a family provisions claim comes around, you're probably looking at least 2 or 3 years and at least 20% in legal fees, up to obviously around about 80%. So whatever you do in your estate, you've just got to be very careful of. Now, one of the solutions is, again, what we want to do is we want to keep the assets in our own name and keep those protections, as you said, Lan. So what we can do is we can set up what we call a family protection trust. That family protection trust is also important. It's very different to a discretionary trust, and it's very much the same sort of thing that the Queen of England uses. So in that instance, what we have is we've got a trust, and in that one, let's say it's yourself or the small business owner, you are the appointor. So effectively, you control that trust. You also control. You're also the trustee. Your spouse may or may not be in there. The key issue about that is that we determine, and again with your accountant, you determine your net wealth or all your net worth outside of this family protection trust and your super. So you've got to exclude anything that's sitting in a trust or super is excluded. Remember, it's only your assets that are sitting in your own name that are really targeted or going to be subject to a family provisions claim. So what we want to do is we then work out a net worth and then we transfer that into our family protection trust. Remember, this is the one that you're controlling. You have complete veto power. Also, you can limit distributions only to bloodline only. And that also happens that obviously if you pass away, your children may become that next appointor, that family protection appointor. And again, they can only pass it down to your bloodline. So that DNA you've got is actually very important and ensures that wealth goes down the track. In fact, there's ways of setting these up. Generally, these trusts work for 80 years, but we've got ones to go into perpetuity, which is really important, like a fund and also like a company. So what we do is we do a gift of that net worth. You don't switch your assets. You're just looking at your net worth or your net wealth, and then we transfer it over into the family protection trust by way of a deed of gift and also a promissory note. At that point in time, obviously, you still want to utilise those assets, and you still want them protected in the family protection trust. It is then lent back to you, and then there's just a peppercorn interest, which is payable at the end of the loan. And usually the loan goes for 20, 30 or 40 years. So you've still got full utilisation of these assets, but if someone wants to attack you, you have no net worth, if that makes sense. You've got the assets, but it's effectively, you might have a bank that's lent you monies, and then with this loan, that family protection trust has lent you monies. In order to ensure the security, obviously we have to do a registered mortgage. You might even have net worth over your family cars. In fact, I've seen people with a really flash watches working at that net worth, and then you do what we call a PPSR, or do a charge over those as well. So everything is secured. So at the end of the day, if you are attacked litigation-wise by the regulator, you can simply put your hands up and say, look, there's nothing there. Likewise, in family law, potentially it has been used in family law cases on estate planning and the protection. There's been Queensland Supreme Court cases on there showing its effectiveness. So it's a beautiful tool, and I like to ask clients that if there's any chance, even if it's a 3 or 4% remote chance that someone's going to make a claim on your estate, then effectively what we do is we put in place the protector, because that way you can control who goes to it, and you can't make any family provisions claims on that. So that's essentially the way it works. It's just a matter of a process of building that. And in addition, another aside for the protector is that if you've got a net worth sitting inside that trust, for example, the goodwill in your business, got cash inside the trust, you've got other assets, you can also do a deed of gift from that family trust over the family protection trust. Essentially, because there's no assets in there, there's really no income coming through. You still need to obviously lodge a tax return, but if there's no income, there's no income, so there's no tax payable. But effectively, you've got this special family protection trust that holds all your assets during your life, and more importantly, after your life as well.
So, are you saying for relevant the entrepreneurs, for the so relevant? So, who's relevant? So, is it someone that has a home? Obviously
absolutely. So the weaknesses with most entrepreneurs, and look, I've been an entrepreneur since I've been 18. Touch wood, I've never been sued, but I have been divorced before. So I'm currently in another marriage. So the first thing, obviously, I've still got my assets, but everything is sitting in this family protection trust. And then that's shared between, ultimately, or put in place. You can either put in fixed directions or just have as a discretionary trust, either way. So you put in place instructions as to what you want to do. It's very, it's used a lot over in the US, because in the US there's death duties. So what it is, it's an inter trust. For those of you who are lucky enough to have a large superannuation fund, it's also worthwhile because there's only so much money you can take out of your fund as a pension. If you've got monies over and above that, generally you must keep that in the lump sum account, which is very dangerous in the event of your death. So ideally, you can also pull that money out if you're over 60 tax-free and put it into this family protection trust. So it has a multiplicity of uses. I can think about 15 to 20, but I don't really want to go into a lot for everyone. I think the main thing is to understand that if there's an exposure somewhere around it, it does solve that problem.
And it's more for those who have a home. So I guess I want to address the question that's have been asked before. When do I start need to, considered wealthy or considered need to protect my asset? Is it when I have a home? Or
when you've got net equity in your home, that's when it happens. Because you can always go back and top up that net equity and put more over to that family protection trust by way of a deed of gift. So that's important. The only thing you've got to watch out for is, obviously, if we've got a home, we don't just get that cash, we've got a bank there. So the bank will run a first mortgage. So what you'll do is the family protection trust is your second banker for that matter. So what they'll do is they will essentially put a second mortgage on that. You'll need to notify the bank, which is important. But for all the people who have done, there's never been an issue with the bank issuing a second mortgage because they've got that first mortgage on, which is really important. The other side of the equation, though, is if you do have that loan, which is sitting to the family protection trust, and you do need to borrow more money on the security of that asset, then you may need to wind back or forgive some of that loan or wind it back so there's capacity in there for it to be borrowed by the bank if you need, obviously, that cash flow inside your business. Look, at the worst case scenario, you can always just forgive that loan and potentially take yourself back to exactly what you want. But it's better to put it in place right up front, and as soon as you get that net equity in your home or you've got investment property, start it off and then build it up over time. And look, it's not only, as I said before, for small business owners, it's not just for family homes. It's for any asset they have outside, whether it's, as I said, whether it's a vineyard or, they're in a syndication with a horse racing syndicate. Anything that you have that can potentially be attacked would be in there. And as I said before, it's not only just for that, but likewise, if you're running your business through a discretionary trust, that's going to be attacked. So you don't want to have any net worth in that family trust. You want to put that over to the family protection trust as well.
That leads me to the next question. What's the result of having this protected trust? Is there any implications of, once you set it up?
So once you set up, the main thing is there's no capital gains tax or stamp duty because you're transferring the net worth, not the assets themselves, because you need those assets in order to get the tax relief outside. So it doesn't make sense to transfer it in because there'd be stamp duty and capital gains. So it solves that solution really well. If you're sued, again, then there's no assets that are sitting in your name, effectively. They're all sitting over that family protection trust. If you're going bankrupt now, and you can't just transfer that net worth over now because effectively a trustee in bankruptcy can claw that back. But if you're in a good solvent position, absolutely go for it right at this present point in time. Ideally, it should be one of the first things that when we set up a trust anyway, or a discretionary trust, have a good idea. We've had a couple of good years under our belt that we would have that family provisions claim. For example, next year there's going to be obviously a lot of businesses that will go down in Australia, and family homes, investment properties will all be, obviously ripe for plundering by creditors. Whereas if they'd had a family provision trust or family protection trust running alongside for such a long time, it wouldn't have been an issue. So you can see that, for a fairly small investment, it's going to be it's going to be quite it's going to have quite a bit of an impact. And look, also, you've got to be very careful about when you're running a company. If you've got a trustee of a SMSF or discretionary trust, you've got to be really careful about that. Is that and ASIC's put out a pretty big guideline on that. That those companies, you may not be aware, but the trustee in bankruptcy can come and take those companies over. And likewise, on death or incapacity, those companies are just laid bare. It's absolutely crazy. So in that instance, what we do is we put in place what we call a successor director solution. So again, that's something else that we run alongside the protector. The protector is nice, but it doesn't. All we're doing is shifting net worth. We want to have as much stuff as we can to build that moat around us. So any structure we're involved in, whether it's the bucket company, whether it's those trustee companies for our discretionary trust and SMSF, we want to make sure that we've got a protection there. And that successor director effectively means that if we're incapacitated, bankruptcy, or upon our death, immediately the successor director comes in and looks after our solution. And for some of those small business owners, I know, for example, myself, you might be involved in a business partnership through a unit trust or a company. You're acting as a director. The last thing you want to do is, if you become sick, disabled, or you die, the last thing you want to do is have the other party effectively running control of that company. Because if it's a director's issue, or even if the shareholders can choose the directors, that can take like 6 months to a year. And the other party that you're in partnership with can plunder that within seconds. So you really need to have that successor director straight up. And it's not just if it's a single director, even if it's a multi-director company or anything you're involved in investment, we want to put that protection around, because otherwise you'll end up, that castle just gets chipped away and you end up with one of the turrets falling into the moat. It just doesn't make sense. So when we go in and we start looking at building that full protection, we look at across every entity you've got. Nothing goes untouched without being, I suppose, moated up or protected, which is important. And that also goes down to not just yourself, also goes down to your bloodline. Ideally, the bloodline, if you've got adult children, not if they're like 16 or 17, but if you've got adult children, they're starting on their way down the track, then we want to bring them into that family protection trust. They can be the beneficiaries. Obviously, they will be as bloodline, but the same thing is if they increase their net worth, then we want to start putting that over into the family protection trust as well. Okay,
let's talk about the bloodline. What are some of the issues that you can explore more regards to bloodline and so that our entrepreneurs and viewers can be aware?
Look, I think the first question is that, I would always ask you can see down the bottom there, on a scale of 1 to 10, 1 being least important and 10 being most important, what's your rating when, how important is it that your family's wealth goes to your bloodline? Because it's very easy, as I said, once you distribute it out, that effectively if it goes to a child who's in a relationship, and you have to be very careful now under the Family Law Act, if one of your children has been in a relationship for 2 years, then it comes under the Family Law Act. So if you make a distribution on your death to them, well, you're going to get at least half. And if they're a spouse with the children, you're looking at a loss of 70%. And even if you try to put it into a testamentary trust or so, there's still potentially a family provisions claim. So what we want to do is make sure that we have that, really good, strong bloodline protection, which is all of our discretionary trusts. We've got what we call leading member trusts, leading member SMSFs, and this family protection trust. The only people who can be beneficiaries are going to be your bloodline only, so that even if we try to distribute to a stepchild, it's just not going to work unless it's at the discretion, obviously, of what we call that leading member, which is like the British royalty. When you have a look at it from the British royalty are probably the best. I mean, that's something we can all emulate on. I mean, the Queen has, huge amounts of assets, and there's a definitive line of succession. Something happens to her, it goes to Prince Charles. It doesn't go to Prince Andrew, it doesn't go to Prince Edward. Something happens to Prince Charles, it then goes down to William. Something happens to William, doesn't go to Harry, it ends up going down to George, and that's just the line of succession. So they're always the leading members of the British royal family, which is absolutely crucial because they're the ones who are in control. No one can sue them. Obviously, there's statutes against that, but everything is absolutely protected for them. And it's the same thing if we have a look at it. The leading members of custodian, when we have a leading member discretionary trust, even if you've got an existing discretionary trust, I would strongly recommend that you upgrade it, because that leading member, puts in place that, we can limit our distributions just to bloodline only, capital distributions to bloodline only. And again, you have that succession, which is really important. So if you think about the Queen, you got the Charles, then you got George, Will, then you got George. Who in your family, in the event that something happens to you, is going to take control of that family protection trust? Or if it's a business in a discretionary trust, turn it to the leading member who's going to then control it for your purposes in case you're getting attacked or divorced, is pretty important as well.
Wow.
Bloodline is always...
Yes, I think that not enough attention is addressed for bloodlines, because with divorce rates, 50% and over, and that just signifies a need to address that issue from the start, so that you are prepared in case something happens.
Lan, it's so many. I think there's so many. Traditionally, the old way of protecting the family home, if you're an accountant, financial planner, medical professional, or you're worried about being sued or personal liability, was traditionally to put it in the spouse's name. Now, that is so dopey these days, because, as you said, with 50% of divorces, if it's in the spouse's name, she walks away or he walks away with it in his name. The danger there is possession. Possession is 9/10 of the law. You haven't got the asset. You can't live in that home. You've got to try and negotiate through the family court, which is going to take you easily 2 to 3 years. Just to even get into that position. So that's why that family protection trust is absolutely all important. In fact, we see so many people who are on their second or third marriages, they keep all their assets, so their spouses say, well, geez, they look fantastic, they're really rich. But at the end of the day, they haven't got anything, because it's all in that family protection trust for the benefit of their children. And alternatively, there can always be a distribution to the spouse. Over time, that second spouse can be brought into the family protection trust, but they have to earn their keep as we speak. And you're quite right, that bloodline it's something that we all know is really important. I can tell you a little story about that one. Is my folks had quite a large self-managed super fund. I've got 2 daughters, which are my bloodline. At that stage, I was in a relationship with a lady, and not a relationship, I was married. I had 2 stepchildren. And my mum brought it up. She said, okay, well, if something happened to you in your SMSF and all that money, or the money went to me from mum and dad to me from the SMSF, and then something happened to you, would it go down to my granddaughters or to go to your stepchildren? I said, well, it'll go to my spouse at the time, and potentially if something happens to her, it goes to the stepchildren. So I've laid that to waste. So she's the one who came up with all this bloodline solution. So for the last 4 or 5 years, I've been busily building bloodline solutions. And these are only just the tip of the iceberg. We've got a whole lot of others there. So the bigger the moat, the nastier the crocodiles we've got in there, the better it's going to be. Because if you have a look at a no-win, no-fee lawyer, they will only take on a case that they're guaranteed to win by 90%. So effectively, they're going to have to spend a lot of resources, a lot of money. So if they see a case where everything's protected, they're just going to walk away, because they're going to do it, which means then the other parties have to fund the litigation themselves. And unless it's a huge estate, it's probably just not going to be worth it. Yeah.
And you touched on SMSF before in your story. So you have a solution for those who have their wealth built in SMSF as well, to make sure the bloodline is honoured.
Yeah, absolutely. So, look, I'm a great believer in family and stuff like that. So we can build a traditional self-managed super fund. We're going to find that I'm going to give you a couple of solutions on this one. We are going to find that the number of members in a self-managed super fund are going to go up to 6. So we can bring family members in. And it's a great idea, certainly when mum and dad were getting to a little bit older, and dad was just on that borderline dementia. They were inside the fund and they were getting some great tax benefits inside the fund. I mean, there was no tax, and there was no tax on the investments in the fund, but really they had no capacity to act as trustee. So what happened is I had their enduring power of attorney for that self-managed super fund. I wasn't in that fund. I was in another fund because only a 4-member fund and my other brothers were in there, but I was able to come in and act as trustee on their behalf. So you can have these funds that next generation. I think it's really important is in there looking after that older generation, and it'll continue on down the track. Now, again, the main thing is we want to have that leading member inside that fund. And that leading member has the power to appoint and remove a member, has the power to appoint and remove the trustee, and has complete veto power over every decision inside that fund, including where your death benefits are to go. So if it looks as though they're going to be wasted out to non-bloodline, and I think one of the issues I talked about earlier is many of us don't realise, you talk about the number of marriages that are breaking up. It doesn't mean that. For example, my young daughter's been living with her boyfriend for 2 years now. He is now legally entitled to 50% of her assets under the Family Law Act, because he is treated as if they are in that marital position. So everything that she owns is matrimonial property. So we've got to be extremely careful about that. We need to make sure we have that line of succession, which is important, building the asset protection, and also that estate planning. And if you've got all that, you're in a pretty good position.
Yeah. Wow. So if your mind is blown away at the moment, like mine is, I think that you don't need to understand everything that Grant has covered, because it is highly, general information today. So I encourage you to, if someone who's interested to go the next step, what is the next action they should take?
Well, I think from our perspective, so the issue that I'd have is that if you have a company, you need to get a solution. If you've got assets, even in discretionary trust, you need to get a solution. If you've got a home or investment property with good net worth in it, which generally happens around Melbourne and our capital cities, you need to get a solution. And you can bury your head in the sand, but I can tell you how many people are looking over their shoulder next year, because if they've been in that Melbourne lockdown, there's a lot of people who aren't going to make it, I can tell you. And so everything they've built and they've worked hard for, and I've been an entrepreneur, I can tell you, we work so hard. I work on the weekends, I'm doing 12, 14-hour days. We put all that stuff in and we're building it, not for ourselves, but basically for our family. And to see that go to waste in such a short period of time, that makes me livid. And look, I the lawyers in my profession just gets my blood boiling, and I just don't want that to happen to anyone. So what I would suggest is either you can come to us directly at Abbott Morley, but certainly if you're one of Lan's clients, I think it's absolutely crucial that you operate through Lan, and then we can work with Lan together to really bring a great solution, because she obviously knows all the structures you've got, all the elements there, so we can work hand in glove, so to speak, and come up with a brilliant solution to build the biggest damn moat you've ever seen in your life. And I can tell you, once you've done that, everyone I know, when it gets to the end, they know exactly where they are, and then they can breathe a huge sigh of relief, because that weight on their shoulder, they know there might be something going wrong with their, in their will, or they've got one child. And the good thing about it is if one of the children falls out, you can change this stuff overnight, and everything can happen really quickly. If you separate from your spouse, I can change everything overnight really quickly. So it's a very, very strong structure, but it's flexible. It's a bit like bamboo. When you think about it, bamboo is one of the strongest structures around. If you've been over to Asia, they use that for scaffolding. So it's very strong, but it's also very flexible. And that's what we want to do when we start building moats.
Fantastic. Look, so you mentioned a valid point, because I've been working with you, Grant, for 3 years now, and I also personally do it for myself with you. So for those of our viewers who are already our success clients, yes, we do offer a consultation where we will help understand your structure so that which solution is best, and then we will engage Grant and his team to put the solutions in place for you. But certainly, if you find any of Grant's solutions or you realize you have a problem, please do not delay and speak to Grant directly or speak to one of our team. We can certainly guide you what's the next stage, what's the next steps to take. But thank you so much, Grant. You are always a wealth of knowledge.
Yeah, thank you, Grant. Well, hopefully, I've done this for such a long time. Hopefully, I know something now.
But you know what, Grant? What I love about you is that you're a lawyer, or and you're sharing the secrets of what a lawyer would look for to attack, not attack, but like to go for the assets of entrepreneurs. So that's what is valuable that we're getting today. So what?
No, it's crazy. Yeah, it's crazy actually. What this really gives me the irrits as well is that you'll have a lawyer who'll draft up a will, and typically superannuation is actually the best asset protection structure ever, and the best bloodline protection. You can do a whole lot of stuff there, but they'll pass superannuation over to the estate. They've got all the family houses and all that. And then it doesn't matter how brilliant they are at drafting, then you've got another lawyer that comes in and challenges it. So everyone wins, every legal person in that chain wins. And look, I just don't, look, that's not my style. Look, I'm more in the family, making sure that everything's left for the family and protecting it from that litigation. People probably don't know, but per capita, Australia has more lawyers per head per capita than anywhere else around the world. And with COVID, a lot of their traditional work is gone. So you know where they're going to. They're effectively going to that litigation side. So we've all got to be really careful.
All right. Thank you very much again. And I'm going to leave your details at the bottom of the video. So for those who want to contact you for any further questions. And we'll get you in again, I guess, early next year to see how you're going with your business and see any updates. Thank you, Grant.
I've got a couple of more really great solutions as well that we're working on, which are really important. But look, thanks for the time. And look, I know all your clients and the people watching this in your Success program are doing really well, and that sort of information will take it to the next level. And really, as I said, whether you use my services or not, hopefully you've taken some ideas around and there's a worm in your head, and do a bit more research into it, do as much. But again, don't wait too long, particularly if you're in Melbourne. Don't wait till next year, because if you lose one or two suppliers, your business can go.
Yeah.
Beautiful.
All right. Thank you.
Okay. Thanks, Lan.
Thanks. And that's it for today's show. So if you enjoyed this video and you enjoyed the content, please give us a thumbs up and share us in the comment what you think about what Grant said. What do you need in your business right now? I know that a lot of my clients are thinking about building a moat around their business and their family wealth. And what is the gap? If you're not sure, make sure you get in contact with your accountant, and especially our team is ready to help you, because with this COVID, with Melbourne, Victoria being in lockdown, uncertainty is around us. So make sure that you have more certainty, a plan to recover and not be left out in the cold. All right. And I'll catch you up in the next show. Thank you, Lan Nguyen from Success Wealth. Bye for now.